I'm Elle Hill, and I'm the founder and CEO of Hill & Company, and we are all about analysis, strategy, and growth for the diamond, gemstone, and jewelry businesses only. I would like to introduce you to Dennis, and we will in tandem walk you through strategy creation.
Thank you very much, Elle, and thank you all for coming. Pleasure to be part of your industry, at least a little bit on the outside. All right, so let me tell you high level what I want to do. I want to tell you a little bit about how we think about strategy at Harvard Business School. My teaching, my research focuses on strategy and strategy execution. I'm going to tell you a little bit about how we think about that. I'll give you some examples of organizations outside your industry, one inside your industry, and then Elle, I think, will make the connections for all of you. All right, let me start out with something that I think is a really important concept in strategy, and the idea here is about the sustainability of performance over time. So how hard is it for organizations to sustain strong performance over long periods of time? This is a really fundamental finding in strategy, and let me try to describe what you see here. Basically, what researchers have done here is to take any set of firms in any kind of market. So imagine that all firms that are on the New York Stock Exchange, all firms on the S&P 500, FTSE, whatever stock exchange you want to think about. Now imagine you just picked a performance measure that you care about, right? It could be sales growth, it could be earnings, it could be return on capital employed. Whatever metric you care about, just split the firms into the top 20% on that metric, the bottom 20%, and then everybody kind of in between, right? That's the basic idea here. Now, what we do is then follow those firms forward, and we see what happens to those firms as a portfolio. And you always see a pattern like this, which is really interesting. You always see this. People have looked at this in stock exchanges around the world. They've looked at it with respect to all kinds of different performance measures. And you always get a picture that looks like this. And what it says is the top performers as a group tend to come down over time. So you follow them forward for 10 years. The bottom performers as a group tend to come up over time. Everybody just kind of becomes average over time, right? This is the strong central tendency. And people have replicated this all over the place. And it's kind of interesting to think about what's going on here. Why is that the case? Because it turns out it doesn't matter what the time period is. It doesn't matter what stock market you're looking at. We always see some pattern that looks like this. So let me just ask you here your thoughts on what might be going on here. What are some things that might explain why top performers as a group tend to get worse over time, bottom performers tend to get better over time, and everybody just becomes kind of average? That's the central tendency. Any thoughts on what you think might be going on here? Hypotheses? Yeah, sure. Technology and things become commoditized, absolutely, right? So imagine here, you're sitting up here. This is, say, Apple. Well, who's looking at Apple? Maybe it's Samsung, maybe it's other companies. They're starting to use their own technology. They're starting to copy features of your products and services. When that happens, right, good old-fashioned competition starts to erode profits, right? Everybody's copying who's up here. They're technologically innovating. So we're going to get that kind of, it's going to be really hard in the face of competition to sustain performance over time. Other thoughts on what might be going on here? Yeah. Complacency, right? Complacency, really interesting, right? So look, the firms sitting up here, they should be looking at who's coming up below them, right? And we should be actually trying to innovate ourselves to stay out of this trap of commoditization, right? It turns out it's really, really hard for incumbents to do that kind of innovation. So we know that from lots of different examples. One could look at Blockbuster, one could look at BlackBerry, right, opening up the cell phone market, but for Apple. One could look at Kodak, digital photography coming up. It's very easy for big traditional incumbents to get complacent. Really hard to maintain that over time. Nell, did you have a...
I did, and it's for everybody who's sitting here right now. If you're doing really great right now with strategy, this is an amazing talk for you guys to be here for. And if you're struggling and you're not sure exactly why you're not making headway, this is an amazing talk, precisely for this reason, because everybody is going to that median, that averageness, right? So no matter where you are right now, having a great year, having a terrible year, I'm very excited that you're here to hear this talk.
So the other thing down here, right, you can imagine that you can't live here forever, right? That if you're down here, you have to improve. In fact, these are publicly traded companies, so either you're going to have firms that drop out, that just are gone, that die off, or firms that just get better and better over time. Right? These are the ones that are hungry, looking up here for ideas, and ultimately getting better and better. What this says, though, for all the reasons you're highlighting, is it's a central tendency for firms to get worse over time. That's the central tendency. It's very, very hard to to sustain abnormally high performance over long periods of time. That's the sort of fact that we see over and over. Now, here's the good news. It turns out that this is not true of everybody, right? This is the central tendency, but there are lots of firms that break out of this pattern. And I'll give you one example here. If we look at the airline industry in the US or around the world, this is on average not a profitable industry. If you actually look at the industry average profitability, this is return on equity. It's negative 10%. That's the average. But what you'll notice there is that there are some firms that over a long period of time tend to do better than others, right? They break out of that pattern that we actually saw on the prior graph. Southwest Airlines is a great example, and I'll come back to that. They're kind of one of the only US airlines that's delivered shareholder value consistently over many, many decades. So they're a good example of a firm that breaks out of that pattern. It must mean they're doing something in their strategy that's hard for others to copy, right? They're making trade-offs that are difficult for others to make. And we're going to get back to what the essence of those kinds of trade-offs are, how to think about strategy to make sure that you can sustain performance over long periods of time. That's the basic idea of how we think about strategy.
And what I want to lean into that Dennis just said is they're doing something in their strategy that is hard for other people to copy. Right? So we see a lot of, we've been inspired by, and we're going to do this but cheaper in our industry, right? That's not what's going to be hard to copy. Hello, Kathleen. That's not what's going to be hard to copy. So that's not what's going to protect your business as you move forward. So that's a central tenet that's super important. First of all, uncopyable portions of your strategy, but second of all, having a strategy. I know that sounds a little bit out of the box here, but a lot of businesses miss that step, which is why we're talking about how to create a strategy and one that is not copyable.
Hi, Elle Hill here. How do you stay on top of the business industry trends that are shaping our industry today? One way is to join our mailing list. You'll receive insights from me, my team, industry experts, and beyond. There's a link in the description below so you can join our mailing list today.
Back to you.
And one of the ideas we're going to talk about when we talk about trade-offs is the idea of focus. And when you look at these firms that are able to sustain very high performance, they have very strong focus on what customers truly value, a very deep understanding of what their customers value, what kind of trade-offs their customers are willing to make. And then ultimately, they're designing their operations and their execution systems in ways that deliver maximum value in ways that are difficult for others to copy. That's going to be the central idea. What I'm going to do next, though, is give you a sense of the building blocks for doing that, at least the way that we think about them, and hopefully I can connect those to your industry. So let me start with the first one, the foundation of strategy, this question of who's your primary customer. This seems like a simple question, but it turns out to be actually deceptively simple. It turns out to be very difficult for many organizations to answer this, and let me give you 3 examples. The first one is McDonald's, right? You think this is a straightforward example, right? McDonald's, it should be the people that walk into the restaurant, the consumers of the food, right? That should be the primary customer. McDonald's actually questioned this at one point, and they were trying to think about how do we grow faster than we've ever grown before. And they decided that the primary customer should be big franchise developers, right? People that actually own multiple units, that franchise multiple units. If we focus on serving them, we'll grow really, really fast. Well, what does it mean to switch from your primary customer being the consumer to being the developer? It actually means that you have to start to become like a real estate company. You have to be really good at site selection. You have to be really good at franchisee selection. You have to be really great, actually, at providing support resources to franchisees. It also means a concurrent shifting of resources away from things like R&D on the food, things like service quality and the service regional infrastructure. What happened to McDonald's is kind of predictable. They got the fastest growth in their history, but they also got the biggest decline in customer satisfaction in their history. And they ended up rethinking the primary customer back to the end consumer. So what you see here is it's a dynamic choice, and it's one that depends on what is your objective. Is it growth? Is it profitability? Is it long-term service and reputation? McDonald's was making different trade-offs at different times. The choice on primary customer here affects resource allocation in a deep way. Let me give you another that's more complicated and I think a little more surprising. And that is Merck. So Merck's a large pharmaceutical company. And you can imagine for a pharmaceutical company, there's many constituents that are important in creating value for customers that ultimately consume the medications. And of course, for Merck, right, if we think about who's a primary customer, many pharmaceutical companies would say it's the patients themselves, right? That they're the ones that consume the medications. Maybe we need to educate them on the benefits. We need to advertise to them, right? We'll allocate resources in a particular way. Others say, no, it's the physicians. They're the experts, actually. So we're going to invest in a huge sales force, get out there, interact with the physicians, drive our profits that way. Merck comes along and says, no, it's actually scientists, and not our scientists, but it's actually scientists in other institutions. And if we could produce the best science, doctors will benefit and patients will ultimately benefit, right? It's not that those aren't important, but if we actually produce the best science, we're going to benefit patients and doctors the most. What that means for Merck is they have to organize almost like an academic institution. They have to hire people that want to produce science. They have to give them time to write publications, get peer reviewed, go to conferences, right? Produce science almost like an academic institution. And again, you can see this choice, right? Not right or wrong, right? It just means that you need to be clear on it because it will affect resource allocation in a deep way. Mm-hmm. Let me give you the final example that I think will be quite familiar to all of you. So Amazon, right? Like any platform company, you actually need multiple parties on your platform. But when push comes to shove, when I really have to allocate resources for innovation, who am I going to do that with? And for Amazon, the real question is it the consumers, right, where we're delivering products, or is it the sellers on our platform? And Amazon is unambiguous that it's always the consumer, right? It's always the end consumer. What does that mean? It means all of their performance metrics are about convenience, how quickly they're getting things to you, the number of clicks before you actually order an item and get the item, these kinds of things. All of their technology is there. It doesn't mean sellers aren't important, right? We create value for sellers by creating value for consumers. We create network effects, but they're very clear that consumers are the primary customer.
So there's 2 points I'd love to add in here. One is when we look at the Merck, the KPIs, the key performance indicators that the executives at Merck are going to put on their salespeople, on their finance people, where you're going to allocate budget, that's going to change significantly if you want funding for research and you want time and space for that to happen, rather than it was just sell to the consumer, right? It's going to change the way they allocate their budgets and their dollars. So now let me bring this into my intimate experience. The business that I ran before Hill & Company was called Plucka. Some of you may know it. And what we did was we were a retailer. We were an online only, and then we were in Hong Kong, New York, and London with retail shops with 99 of the most incredible non-derivative designers that you could find. Amazing designs, unique designs. The media loved us. The end consumer loved us. Who was our first customer? The people who were buying the jewelry? No. Our first customer was the designers, because they were amazing. They were incredible, but they didn't necessarily know how to market themselves. They didn't necessarily know how to run their business. So if we focused on creating that opportunity for them, they came to us like droves, and then we had the most amazing jewelry, and then the media and the consumer followed. So it's an example from our industry that I thought might be helpful.
No, it's a great example, and I think what you want to think about here when you talk about a primary customer, it doesn't mean others aren't important. The real question is, what's your theory of value creation? How do you create the most value? Which of these constituents will unlock the most value in your entire ecosystem? And I think that's what you are.
And if I can jump in again to say, once you've made that decision, it starts acting like a North Star that when you say, oh, should we put more money into advertising to end consumers, or more money into elevating the awareness of the brands that we carry? We know how to answer that question when we know who our primary customer is. So it's not a mamby-pamby thing that you just identify and then put in a file somewhere. It helps you make every decision as you march forward.
So this is exactly the next point, which is, why is this important, right? It's important because, first of all, does everybody know what your primary customer values? You can't have a strategy unless you actually answer that question first. The other is what Elle's hinting at, which is you have to really ask for the majority of your resources to providing what that primary customer values most, right? It's really about resource allocation ultimately. And let me give you an example in your industry, and I'd love to get your views on this one. So here's an example in your industry. So I am going to first do a little word association game. So this is Tiffany's. When I say Tiffany's, what are the first words that come to mind? Sorry? Love? Okay, what else? New York. Okay, yes, New York, sure. What else? Blue box, right? Like engagement ring, right? This has a very, very strong brand, right? The reason I'm bringing this up is anywhere I go in the world and I ask any group of people, students, executives, they're going to say words like this, right? It's got a very, very strong brand. But here's what's interesting. Not terribly long ago, they actually had this problem that started to threaten that brand. And here's the problem. So Tiffany's has what let's call our original customer. The original customer comes in, buys the $50,000 engagement ring, wedding ring, right? Very expensive, once in a lifetime type of jewelry, we hope at least, right? That's the idea. And that's the original customer, right? And here's the thing, right? They're typically buying high-end products. But they're coming into the store saying, you know, we'd love to interact with Tiffany more often. We'd love to buy, you know, things for our family and for friends, but you don't really have things that we can purchase. So Tiffany's comes with this great, beautiful line of silver jewelry, right? Lower price point. So I'm going to call that the low-end product. Low-end does not mean low quality, right? It just means lower price point in this particular case. High quality, but low-end relative to their traditional product. Now here's the thing, right? You'll see this thick arrow here, and what that says is that the original customer is interacting with Tiffany's a lot more in the context of that silver jewelry rather than the original products, right? What they're doing here is, again, once in a lifetime big event. Here they're spending a lot of time buying for friends and family gifts and the like. The problem, or the great thing, but also what turns out to be a problem, is that it also attracts a new type of customer, right? It attracts a lot of teenagers. It attracts a lot of people that are coming in and buying this lower price point jewelry. They want the Tiffany's experience. They love to come into the stores. The problem it creates, right, it's great because it's high margin products. Wall Street loves it. They're growing, all of those things. The problem it creates is crowding inside the stores, right? And the crowding gets so bad in the stores that they're trying to figure out what to do. The short-term solution was to get people to take a number when they come in the store. So let me ask you how you feel about that solution for Tiffany. Yeah,
It's like a butcher shop, right?
Tell us that you're just horrified by it. Yeah, horrified by it. Right, so that's not a long-term solution, and they know that, right? And so let me put you in their shoes. You're seeing this crowding happen. None of us like the take a number. It's not the Cheesecake Factory. None of us like that. What would your solution be? What kind of ideas might you have for dealing with this crowding problem at Tiffany's if you don't like the take a number? So like a separate store. Yeah, we'll call it Tiffany Light, right? Like Tiffany Light, we could have a separate store, right?
DKNY to Donna Karen, right?
Yeah, right. And lots of firms do this, right? We know that Armani and Armani Exchange, right? We know that in the auto industry, it's Toyota and Lexus, right? We actually know lots of companies that do that, right? High-end and low-end brand. Look, here's the interesting thing. Like, this is a great idea, and it comes up a lot. The reason I like this example, though, is that that solution's really difficult here. It's a great idea. The problem is, right, this big arrow here, everybody here wants the same experience from Tiffany, whether or not they are going for the low end or the high end products, right? That's what everybody's coming for. They want the same experience. People don't typically want the Tiffany Light. So it's a great idea, but the reason this is an interesting example is it's actually really, really hard to do that.
Because you don't have the funds to support that kind of experience with the lower price point goods, right? So there's got to be a different solution. We've got some idea over here.
It's a great idea, though, absolutely.
They need more employees, she says.
Oh, yeah. Absolutely. Yeah, more employees, right? More employees, so staff up, increase capacity, right? Right? Now we're worried about crowding the store with employees and people, but that would certainly be right. Increase capacity in some way, right? That would absolutely be
And then being very department store.
Say that again? In the department store. Different venue, different collaborator.
Different venue, right? So look, either increase capacity or get a different venue, right? Here's the problem again, right? People really love coming into Tiffany's, right? In fact, some of these teenagers, they're coming back over and over to get the jewelry cleaned, right? They even like to come in the store to get the jewelry cleaned, right? They love to be there. So people really want to be there, and it makes these kinds of solutions really, really difficult. So here's the thing. These are all great solutions, and in fact, we can find lots of brands that have done these solutions. The problem is they weren't available to Tiffany's because they just can't separate the experience from the product itself. That's the problem here. So the question is, what do you do next? And what Tiffany's does next is they actually start to say no. They actually start to choose a primary customer. And the way they say no is they raise the price point on the silver jewelry. First by 50%, crowding doesn't go down. Then by 100%, they double the prices. Now it starts to make a difference. They eventually increase by about 150%. It makes a dent, right? They have to sacrifice some of that profitability and volume to protect the long-term brand. This is their way of effectively choosing a primary customer, right? By raising their price point, they're saying no to one segment, saying yes to another. In other words, the reason I chose this example, right, is you could see here, they had to make a choice of who's the primary customer, make these trade-offs. So these are great ideas. They come up every time I do this, but this example makes it particularly difficult.
Mm-hmm.
Yeah. Online experience, yeah.
It's really good. Got it.
So digital experiences would be one. And in fact, I think this day and age, that's a place where we really have to start to think about things here. At the time, though, their choice was really about saying yes to one group, no to another. But certainly in this day and age, we can start to think potentially about some digital solutions that might be good enough experiences to deal with this problem more effectively. Yeah.
And the key there is only once they identified, okay, our number one, our primary customer is the original customer, then they could have the courage to fire the other customers, basically, by moving it out of their price range. And they knew that they were following exactly what they needed to do by identifying their most important customer.
Okay, so let me share with you another interesting example. This is outside your industry, but this is, I think, a really interesting example because it gets to this idea about strategy as focus, strategy as trade-offs. And the idea here being that strategy is as much about what you don't do as it is about what you actually do. Here's the example. The company is called Commerce Bank. Commerce Bank was actually bought out by Toronto Dominion Big Bank in Canada. But at the time that this bank was founded, they became very quickly the fastest growing, most profitable bank in the US. And why that's interesting is that they were very, very different than every other retail bank in the US. They actually offer the worst rates in every market that they're in. They're unapologetic, so they don't compete on rates. Most banks get customers and grow by competing on rates. They're unambiguous that we are going to offer the worst rates. We're not going to pay you anything on your deposits. We're going to offer not the best rates on loans, but somehow they're the fastest growing, most profitable bank despite this. They also make no acquisitions. They grow organically, and that's the other way that most banks acquire customers is by acquiring other institutions, right? And so they're not making acquisitions. They're offering the worst rates. They're not competing on that basis. Yet somehow they become the fastest growing, most profitable. So what's interesting about this is to look at why. And here's what they did. They basically went out and looked and said, if you look at the surveys, everybody says that they care about rates, but actually if you looked at what consumers actually do in terms of choosing banks, very few actually choose the banks with the best rates. Their actual behavior says that they're not really doing what they're saying, they're not really valuing what they say they value. And what it turns out is when you look at the surveys at the time, what people are saying are the biggest pain points in the industry is that bankers' hours. Banks aren't open when I need them to be, right? They're not everywhere I need them to be. They close at 4, they open at 9. Commerce comes along and they say, we're going to offer convenience on a very different level. We're going to be open when you need us to be. That means in some cases their branches are open to midnight. It means that they are open very early in the morning. They're there when people need them, right? Well, it's always interesting to ask why others don't do that. Whenever you see some firm offering something that others don't, addressing a real customer pain point, you want to ask why others don't do it and why they're able to do that. And the answer you start to see traced here in the Commerce Bank case is exactly because of what they don't do, right? They actually offer the worst rates, but they don't say, look, we're going to just take that and increase our profitability. We're going to feed that back into creating value for you as a customer. So what they do is basically say, look, we're going to offer you the worst rates. That's going to allow us to keep our branches open, hire the people, keep the staff, keep the electricity and lights on. That's going to allow us to provide this convenient service that's very different from everybody else, right? In other words, what this says is they're deliberately being bad in order to be great, right? They're being bad at something they know customers care about. To be best in class is something they care about. And here's the thing, it's not just that they care about this. Commerce is making a bet based on data that customers care more about this than they do about this. They're deliberately going to trade this off in order to be best in class at the thing that their primary customer actually cares the most about. So,
No, it reminds me of when ESG there were surveys everywhere saying, does the customer care about ESG? We're going back a decade now, right? We said, yes, they do. But when they got to the POS, they didn't vote with their wallet, right? They wanted the best price. So you do have to really understand what is important to your customer, and you're going to talk more about that. But there's another interesting way that they managed to do this.
So another interesting thing they did is that they also said the other pain point is that when you actually walk into a bank, they treat you like a number and not a person, right? Bank tellers aren't friendly. They don't have a lot of empathy for their customers, right? There's a lack of friendliness. People want a good interaction. Financial services are sensitive. And so people generally want that. But actually, banks aren't doing that. And why aren't they doing that? It turns out that because most of them have very complex product portfolios, right? They have dozens of different kinds of checking accounts, different kinds of loan accounts, investment products. I have to hire people with expertise. People with expertise are not always the people that are best with customer empathy. What Commerce does is say, we're again going to do the same thing. We're going to have the most basic products, right? Very limited product set in terms of our offerings on checking accounts and loans. We're going to then, that's going to enable us to hire people from outside the industry. We can hire people from healthcare. We can hire people from hospitality that actually have customer empathy. And that will allow us to create better customer interactions. Again, we're going to be bad on something customers may value, right? Product variety, in order to be best in class at something our data tells us that they value more. I think when you step back and look at this, what's interesting about it is several ingredients that make a good strategy. First is the idea of a few points of meaningful differentiation, right? So it's not being better at everything. It's picking a few points of meaningful differentiation based on a really deep understanding of what your customers truly value. It's then also being willing to make trade-offs, right? Not trying to be all things to all people, actually deliberately being bad or keeping things at just acceptable levels in order to be best in class at what your customers value most. When you go back to the graph I showed you at the beginning, every firm that breaks out of that pattern of declining performance over time has some kind of focus like this. And why is that the case, right? Just go back to what we heard in the very first comment, which is that it's actually really hard to copy this, right? If you want to copy this, it's not just about saying these things are important. I have to now make the same kinds of trade-offs in the way that I organize that Commerce does if I want to compete against them. Making these kinds of trade-offs makes it actually quite difficult for others to copy what you are doing.
And I think we've all experienced it, and maybe some of you have experienced it today, where you go to a manufacturer and you say, can you do X? Yes. Can you do Y? Yes. Can you do Z? Oh, yes. All of a sudden, my trust is eroding, right? Because they're not saying, actually, we don't do that. That's not us. So not only are you also being able to allocate your budget and resources to the things that you are putting a stake in the ground and saying, we're the best at this, you also are able to gain authenticity and trust from the people who you're speaking to, because they go, if you told me you're bad at that, and you said you were good at this, you must have been telling the truth.
So one of my colleagues who was a former student is now a tenured professor at HBSE and did an experiment exactly on this. And actually looked at the idea of what happens if you communicate the trade-offs that you make in your model, which is not easy to do, right? And actually, you're telling customers you're bad at some things, right? Not only what you're good at, you're also telling them what you're bad at. But what he does find is actually there are lots of benefits. It's trust. You're communicating authenticity. They understand what you're about. You're allowing your right customers to select in, maybe the wrong customers to select out. Right. So he finds all sorts of benefits of this transparency that might come from not only making these trade-offs, but actually communicating them as well.
Got it.
By the way, Commerce Bank actually advertises, right? They advertise that we are the worst rate provider. And they're doing that because they know. They know that there are certain customers that will never be compatible with their model. If we attract too many of them, it could actually interfere with our ability to compete on the things that we think that we really need to compete on. All right, so I think we're running short on time.
Yeah, I think we have about 5 minutes left.
All right, let me quickly, I want to give you a framework that I think will be, I want to give you a framework that I think would be useful for all of you. In fact, I've done this with executives in lots of different companies, big and small. And it's just an interesting way to think about from your customer's perspective, right? You want to kind of do design thinking, reverse engineer from the value proposition for the customer, what you should be doing as an organization. That's the basic idea. And what this framework does, and I'm going to use the Commerce Bank example, is it asks you to do a few things. And the first is, think about what your customers value, right? If you could actually put yourself in the minds of your customers, this could be through data, it could be through focus groups, it could be through your discussions with your own team internally about what your customers value. Think first about when they're thinking of you versus a competitor, what are all of the attributes they care about, right? In your industry, right, it could be certainly design of the products, it could be price, but it may be lots of different aspects of service that you're competing on, right? And so if you look at Commerce, what they do is to say, look, if we think of customers choosing us versus another bank, of course they're going to care about price, they're going to care about product range, they're going to care about friendly customer interactions, they're going to care about convenience. The next thing you want to do is much, much harder, right? Once you have those attributes, you want to actually think about from your customer's perspective, ordering those from most to least important, right? From the customer's mind, when they're choosing, right, what are the things that are most important to them to least important? And that's the thing that you can't do unless you choose a primary customer and understand them very deeply. The next thing you want to do is to ask yourself very honestly, right, how well do you perform at delivering on those attributes as a firm? Here's the thing, what all of us want to do is this, right? We want to be fives for everybody. The implication of this, though, is too expensive, right? We can't be fives to everybody on every dimension. In fact, firms that try to do this end up being average at best to everybody. Here's the power of the Commerce Bank example, which is that by making these trade-offs, right, you are not spending resources, over-investing resources on things your customers care less about, in the service of actually over-investing, if you will, on things your customers care more about. This is a very useful exercise to go through if you could do it either with data or with your top team in your organization. Because what most of you will find is that you're going to look something like this, right? You might be under-investing in things that truly create value, over-investing in things that you find customers don't add a lot of value to customers. This just becomes a resource allocation issue. You want to shift resources from underappreciated attributes to attributes that create more value. That's the idea. We can't do that if we don't understand our customers very deeply and haven't chosen a primary customer.
And that is where most of the businesses that we interact with and the clients that we deal with and our colleagues in the industry, this is where most of them present, is in that middle. And really what we want to find out is, what is your superpower? What is the thing that you are actually uniquely positioned to solve a problem for, or uniquely positioned to create an opportunity for your primary customer? And then let's lean into that and take some budget and time and energy allocation away from the things that should be on the left-hand side of that chart.
Okay, and very quickly, I want to just bring back Southwest Airlines. Remember Southwest Airlines? We saw it in the airline industry. They're one of the ones that kind of break out of that pattern of having sustainably high performance. They have the same basic idea. If you look at Southwest Airlines, they're not all things to all people, right? They're not going to be best in class at everything customers might value, but what they're going to compete on is friendly service and low price, right? They're going to have a primary customer that values those things more than anything else. They're going to make trade-offs to be best in class at delivering on those. Now, here's the thing. If I look at Southwest from the perspective of a full-service airline customer, for their primary customer, for those of you that care about the first-class seats, for those of you that care about priority boarding, those of you that want onboard amenities, you're not going to get that on Southwest. Southwest is not going to look attractive to you. In fact, this is what Southwest is going to look like to you, which is great for Southwest. Why? Because Southwest is creating white space where it matters most, right? They're differentiating on the things that actually matter most for their primary customer. They're not over-investing in the things that matter less for their primary customer. They're letting those go to the full-service airline here. In short, they're creating white space with competitors where it matters most, right? And we need to think very carefully about that as well, not just how we look as an organization, but how do we look relative to the competitor that keeps us up at night. All right, so, and here's the thing, right? You can see that immediately here, if a full-service airline wants to copy Southwest, they can't just start to do these things better. They have to start to really shift resource allocation and make trade-offs in the same way that Southwest does. Every single full-service airline has tried to do this. They've tried to create their light version of an airline. They just can't make the same trade-offs. Those have universally failed, right? And so you can see how difficult that is in that space. All right, let me just end on this note, which is the idea here is that organizations have a choice to make, right? The choice that you have to make is you can either make those tough trade-offs or they end up getting made for you. Ultimately, you end up being average at best to your customers. And, the key questions that you should be asking yourself, who are your primary customers? This is where we started. What do they value most, right? What are the attributes they truly care about when they're thinking about you versus a competitor? What would it take for you to reliably give them those things? And what would you need to give up in return, right? This idea of being bad to be great, strategy is as much about what you choose not to do as it is about what you choose to do well. That provides focus. That's what creates ultimate value for customers.
Absolutely. And I want to click forward to the QR code on the screen, because there were some sections that we didn't get to go over today, but Dennis and I are going to be here after the talk. And if you scan the QR code here, all of the slides that we have presented will download to your phone immediately. And I want to make sure, it's one more, I think, after that, or did you want to go back to it?
Let me say one quick thing.
Yeah.
I'll just say one quick thing. When you do go to the slides, you'll see here, I think this is pretty much a great summary of what we just covered, which is it's about customer focus, strategies about meeting customer needs, not just selling products and services. It's about meaningful differentiation, right? Every example there has a few meaningful points of differentiation, right?
Not a lot.
Trade-offs, right? And this is a leadership issue. It means having the courage to be bad in order to be great. That means you have to make tough decisions about where you're going to make trade-offs. And then the last piece is it's about both capturing and creating value. And I like to just highlight this because it's very easy to get in the mindset of just trying to capture value, right? Just simply increasing prices, trying to squeeze suppliers, that kind of thing. That can work in the short term. The real issue is how are you truly creating value, growing the size of the pie for everybody. I think that's a really important lesson from all of this. And the final thing I will just quickly say on this, and I won't go through this, but I will just say that that is one piece, right? That once you have a great strategy, there are a number of things you have to do to execute. That's a topic of a whole other talk, but I will just point you to this slide that there are building blocks for once you have a great strategy. What are the things you have to put in place as an organization to execute and to really make sure that you are sustaining strong performance over long periods of time? And you can see there are several building blocks here.
I want to say a big thank you to Dennis, who came down from Boston this morning to share all of the way we approach strategy and creation and strategy execution. So thank you very much for coming today. Bye for now.
If you like that video, you're going to love the next one. It's full of our expertise and tips on diamonds, gemstones, and jewelry, growing your top line revenue, and business strategy. Just click on the link, subscribe, and hit the bell button so that you'll be notified of our next videos, and give us a like. Bye for now.